Treasuries heading towards the best first 6 months in 15 years. Think about that. What is driving that? Well, according to our next guest, fear and greed and, well, mostly fear. We've seen that on the stock markets, too. James Caron is Global Head of Interest Rate Strategy at Morgan Stanley. And, Jim, quite a statement, of course, talking about fear. And you have seen that, right? You've seen that in the flattening of the yield curve. Ahead of these jobs numbers, what does that tell you about the bond market?
Well, we at Morgan Stanley feel that there's a few things at work here, and we have to go through the timeline. And clearly, we started with a lot of risk aversion through May, certainly concerns about Europe and what have you, and that, you know, and then it started to move into talks of fiscal austerity. And these are talks that are going on in Europe, going on in the U.S. And while that's a good thing for the balance sheets, it's not such a good thing for growth. And what it really means is that we end up getting slower growth, not just in the U.S. but also in Europe and maybe even globally. And that's one of the key drivers that are keeping yields lower. And then what it's done, essentially, if you look at the asset allocations in bond portfolios, many people started off the year very short Treasury product and longer spread product. And now what they're trying to do is play catch up and buy back their Treasuries and get back to a neutral weighting as the uncertainty is a lot higher.
Well, how long is that expected to happen for, Jim?
Well, it's been happening for the last 6 to 8 weeks. To the extent that it may be done, I think quarter end might be a good benchmark to say that maybe we're closer to done at this point. I think we're probably 85% of the way done. But I think what ends up taking hold is that, you know, we still expect 3.5% growth this year. We expect 4% growth in the second quarter. I think the growth dynamics are still good, but they're going to be slow to manifest themselves. But as they do, I ultimately believe that yields are going to rise.
Well, then what happens to Treasuries then?
Well, Treasury yields, I would expect that we would get towards the 3.5% mark, you know, closer to the end of the year.
Okay.
You know, we argue that yields aren't going to move all that much higher because there's still a lot of money out there, and yields would have to punch through a wall of cash in order to get, you know, up substantially higher.
So if you were short Treasuries, you might want to be short now? I
think this is the right time. This is the right location. You know, it's not to say that yields couldn't go down a little bit further. We think that there is risk that the 10-year yield goes down to 2.75%. But from a risk-reward perspective, I think it's better to be short here than it is to be long.
Jim, could the jobs report today, or at any moment, we're going to get it in about 20 minutes, could it change the game at all for Treasuries?
I think it can. I mean, if the number comes out particularly weak today, then that's just going to confirm the last week payrolls. And then people are going to look at that as maybe the start of a trend and maybe what might ultimately become a double dip. And people are going to start to price that in. And then they're going to start to think about deflation that comes from the result of a double dip. But look, now I think that's completely really unrepresentative in the sense that if you look at where TIPS break-evens are trading, they're at 1.75% in the 10-year. The 10s 30s curve is near 20-year steeps. We're not seeing any evidence of deflation whatsoever. So to the extent that people start to price deflation in, yields could go a lot lower.
So you think they're wrong then, those pricing deflation?
I think those who are wrong at this point. And I think that we could get a much sharper move to higher yields once the growth dynamics take hold.
Stock markets, though, Jim, and I know you're not watching the stock markets all the time, but I mean, are they misinterpreting the economic data, or is I mean, who's right in this? Are the stock markets or the bond market? Well,
what the stock market people tell me is that they're following the bond market. So it's a case of follow the leader. And if you look at where valuations are in equities, if you look at price to book levels, I mean, we're getting back down to levels that we haven't seen since the fourth quarter of 2008. So you can argue that valuations in the equity markets are extraordinarily cheap at this point. So if we do get this asset reflation trade, which we think that we will as we get the growth, then I think stocks are probably a pretty good buy here too. I mean, I'm not an expert in that space, but that's what it would look like to me.
Okay, and you know, real quickly, Jim, I mean, we've had actually lots of issues resolved, right? We had some issues resolved in China. We've got the financial reform bill almost passed. Why isn't that affecting, though, sentiment even more?
That's a great question. It's a question of these fear factors being knocked off one by one. Look, I mean, the long-term repo operation, the 442 billion euro operation, went off without a hitch. We rolled about half of that, and that hasn't been a problem. The LIBOR has been stable. Europe has been able to fund itself. And yet we're ignoring
all of that, right?
People are ignoring it. I agree. I just think it's more of a fear factor right now. People think that with the fiscal austerity measures taking hold, that we're just going to have slower growth and that yields should be lower. There's less inflation risks, and as a result, and plus you have this giant asset allocation trade going back into Treasuries. So all of these things culminate together to contribute to keeping yields low.
Okay, Jim, we'll leave it there. Good to see you as always. Jim Caron of Morgan Stanley talking about the Treasury markets.